Welcome to the deep dive. We're the place that cracks open interesting documents, reports, to give you that inside track. Really a shortcut to being properly informed.
That's the goal.
And today we're diving into, well, it's kind of a riddle. Imagine this. A company announces it's dramatically boosted shareholder equity, doubled its revenue.
Sounds great so far.
Right. But at the same time, reports a pretty significant accounting net loss. It just sounds completely contradictory, doesn't it?
It really does on the surface.
But that's exactly what happened for Markel back in 2000, a time they actually called a truly event-filled year.
Yeah, an understatement, perhaps.
So in this deep dive, we're going to unpack Markel's 2000 financial review. We'll look at how they navigated what they themselves termed a difficult market, mostly through a huge acquisition and a lot of internal reorganization. Our mission, really, for you today, is to pull out those key insights, financial performance, the big strategic shifts, market conditions.
And crucially, what it all meant for shareholder value, that underlying question.
Exactly, especially when the numbers seem to tell such a complicated, layered story. And look, this isn't just history about one company.
No, not at all.
It's really a fascinating look at how businesses communicate, how they strategize, how they adapt, especially when things get turbulent, transformative. You'll get a much deeper sense of that intricate dance between big ambitions, operational hurdles, and the financial bottom line.
And those are insights that are super relevant today for any business you might be watching or invested in. It's truly a standout case study, I think, for anyone trying to get their head around long-term value creation.
Yeah.
We're looking at a time where, on the surface, things look maybe messy, tumultuous.
Yeah.
But underneath, there's this powerful strategic story unfolding.
Right.
The 2000 review gives us a kind of front row seat to how Markel managed to turn some really significant challenges into opportunities, building resilience, and really strengthening their core philosophy along the way.
Okay, let's get into this apparent paradox then. So 2000, clearly a year of huge change, big challenges for Markel, and they didn't really hide it, calling it event-filled and a difficult market, defined by this big strategic reorganization. So not just a tough quarter, this was fundamental, wasn't it?
Absolutely. Foundational is a good word. The biggest strategic move that year, the one that really reshaped Markel, was the acquisition of Terra Nova. That's Terra Nova Bermuda Holdings Ltd.
Yeah, Terra Nova.
It happened in March 2000, and it immediately became this massive integration project. They rolled it into what they newly set up as Markel International.
Okay.
And the strategic thinking was, well, pretty clear. Markel wanted serious access to specialty international insurance markets, expand their global footprint in a big way.
A big step up
A
internationally.
huge step. It was ambitious, and it instantly doubled their revenue base practically overnight.
Yeah. And this is where the story gets, well, really interesting and maybe a bit confusing at first glance. Because despite this massive strategic leap, doubling revenue, they reported an accounting net loss. $28 million.
Yeah.
Which, if you're just looking from the outside, that's a head-scratcher. Where's the very first place you look in a report like this to figure out that kind of contradiction?
That's exactly the right question. When you see a headline loss like that, next to massive growth, a big acquisition, it's a flashing light saying, dig deeper. Don't just stop there. And the review does clarify it. The net loss was mostly down to two main things. One, losses from business lines they were actually shutting down, discontinuing.
Getting rid of unprofitable stuff.
Exactly. And two, the newly acquired Markel International business itself, which was still finding its feet operationally. It wasn't profitable right out of the gate.
Okay.
But the real insight, the kind of aha moment, comes when you look beyond just that net income figure. You look at their comprehensive income.
Comprehensive income.
And that was a positive $81 million.
Wow, okay. That's a massive swing. From negative $28 million to positive $81 million. So maybe unpack that for us. What exactly is comprehensive income, and why is it so important here, especially since you mentioned it was largely driven by unrealized investment gains?
Yeah, excellent question. So comprehensive income, it's broader than net income. It includes certain gains and losses that don't hit the main income statement right away.
Okay.
Things like those unrealized investment gains. And unrealized just means basically poker profits. It's the increase in value of investments they still own but haven't sold yet.
So the value went up, but they haven't cashed the check, so to speak.
Precisely. And remember, Markel's an insurance company. Insurers hold huge investment portfolios.
Right.
So while the standard accounting might show a net loss because of, say, operational issues or one-time write-offs from the acquisition,
Right.
their actual underlying wealth, the total value of their assets, was growing quite significantly because their investments were doing well. And this isn't just some, accounting quirk. It's a really profound lesson in how companies built for the long haul, like Markel, create real wealth, even when maybe the market noise or short-term accounting rules suggest otherwise. A loss on the books doesn't always mean value isn't being created.
Fascinating. So despite the headline loss, the operational growing pains, Markel was still laser-focused on its core mission, building shareholder value.
Absolutely.
And they had the track record, right? Book value per share had compounded at, 23% for the previous 10 years?
An incredible number. Yeah.
And even in this messy year 2000, book value per share still grew 19% if you exclude the effects of the Terra Nova deal itself.
Still very strong growth.
So for an insurer, why is book value per share such a critical metric, maybe even more critical than traditional earnings per share?
That's a really crucial point for understanding how Markel thinks, their whole philosophy. For an insurance company, book value per share is often, a much more reliable indicator of true economic progress than just quarterly earnings. Book value is essentially the company's net assets, what it owns minus what it owes on a per-share basis. For Markel, which sees itself as like a collection of good businesses plus an investment vehicle.
Right, the three-engine model they talk about.
Exactly. Growing book value is paramount because it directly reflects the tangible wealth, the equity that belongs to the shareholders. It shows that compounding over time.
So the actual net worth of the shareholder stake is going up?
Precisely. And in 2000, despite that accounting loss, shareholders' equity, the total book value jumped significantly. It went from $383 million up to $752 million.
Right.
Or, on a per-share basis, from about $68.59 to $102.63. That substantial growth, driven by both the acquisition assets and those investment gains, clearly shows that real lasting value was being built, even while they were wrestling with those short-term operational issues.
Right. So given that ambitious strategy, that backdrop, how did the operational engine, the underwriting, actually perform, especially in what they called a hard insurance market? Let's start with North America. That seemed like the bright spot.
It really was. The North American operations were, a shining star in an otherwise tricky year. They reported excellent performance with a combined ratio of 97%.
And remind us, combined ratio lower is better,
Right.
right? Below 100 means profit.
Exactly. It's the sum of claims paid out and expenses divided by the premiums they earned. So anything under 100% means they're making money on the insurance itself before even considering investment income. 97% is very solid, very profitable underwriting.
Okay.
Their domestic business had good, profitable growth, and they even expanded it a bit more with another small acquisition, Markel Southwest Underwriters, which added to their North American specialty lines.
So the core was strong.
Very strong. It really highlights that while they were taking these big swings internationally, the home base remained disciplined and profitable.
Okay, but the international side, especially integrating Terra Nova, that sounds like where the real struggle was initially. The review called the results disappointing. A combined ratio of 116%. That's quite a bit over 100.
Yeah, 116% is losing money on the underwriting. For every dollar in premium, they were paying out $1.16 in claims and costs. And it was worse than they expected, about 6 points worse.
Did the report get specific about why, beyond just integration difficulties, what went wrong?
They were actually quite candid about it, which is very much the Markel style, as they call it. They pointed to two main things. First, some pre-existing books of business they inherited, basically before the reorganization, that were just underperforming. Old problems.
Okay, legacy stuff.
Right. And second, the inherent difficulties of just integrating Terra Nova itself, which, as they admitted, initially proved not profitable. Imagine trying to merge this huge, complex new operation into your existing one and finding out, it doesn't quite fit easily and maybe some of its own internal wiring was a bit off to begin with.
Yeah, that sounds messy.
That's pretty much what Markel faced. It wasn't just a vague challenge. It was specific issues with inherited books and the sheer complexity of blending two different cultures, systems, underwriting approaches.
So how did they respond? What was this Markel-style solution they talked about? It sounds like they had a clear plan to fix it.
They did. It's a crucial lesson in how to pivot, really. Their response was classic Markel. Double down on their core strengths. They explicitly implemented the Markel style across the international operations,
What do you mean?
which means re-emphasizing underwriting profit as the main goal, aligning incentive plans to reward that, not just growth. Operationally, they tackled expenses. They centralized key functions, accounting, investments, treasury, actuarial, trying to get efficiencies and consistency.
Makes sense.
They even physically consolidated their London operations. Apparently, they were spread across 6 unconnected offices,
Wow.
and they moved them into a single well-located facility. A very tangible sign of bringing things together. It wasn't just cost-cutting. It was about instilling their disciplined culture into this big new international piece.
Like trying to instill the Markel DNA.
Exactly. They were essentially re-underwriting the ongoing business, getting rid of underperforming programs, and expressing, cautious optimism for improved results in 2001. It was a major overhaul, rebuilding mid-flight, really.
It's pretty impressive focus during what must have been a chaotic time, and they also made that tough call on discontinued lines, cutting loose unprofitable products. These had a combined ratio of 143%, just hemorrhaging money, and represented $120 million in premiums.
Yeah, 143% is just unsustainable. For every dollar coming in, $1.43 was going out.
Their reason was blunt. They didn't believe we had a good opportunity to build a going-forward profitable specialty franchise in those areas. That says a lot about strategic focus, doesn't it?
It absolutely does. It underscores that core Markel principle. Profitability beats sheer size every time.
Yeah.
They were willing to shrink the top line, cut off that $120 million in premium,
Right.
because it was fundamentally bad business. It meant dealing with the runoff, the claims handling for those old policies, which isn't easy. But it showed their commitment to building a truly profitable specialty business long term. Don't chase revenue if it's unprofitable revenue. That's discipline.
And all this internal stuff, the integration, the cuts, was happening while the external market was shifting. They mentioned a cyclical change in the P&C insurance market around early 2000. Prices were going up.
Yeah, the market was hardening.
A hard market. That sounds like, well, both a challenge and maybe an opportunity.
Precisely. A hard market in insurance means prices rise, underwriting standards get tougher, and there's generally less insurance capacity available. For a disciplined underwriter like Markel, this is often a really good environment.
Because they can charge more.
They can charge more, and they can be more selective about the risks they take on. While others in the industry were struggling, the report even says many companies failed around this time. The industry consolidated. Markel was positioning itself as a leader in the specialty market. Their disciplined underwriting, that Markel style, was absolutely crucial here. It allowed them to capitalize on those better market conditions, write good business at better prices, and strengthen their position while weaker players fell away.
So their internal discipline became a real external advantage when the market turned.
Exactly right. Perfect timing, in a way, to have that ingrained culture.
Okay, let's shift gears slightly. Beyond the underwriting battles, the investment side was, as you said, this silent engine of growth in 2000. It was a huge part of that positive comprehensive income. Investment income itself jumped massively from $88 million to $154 million, mostly because the Terra Nova acquisition brought a bigger investment portfolio with it.
Yeah, a much bigger asset base to generate income from.
So what does investment income typically mean for an insurer like Markel? And how does their overall investment philosophy fit in?
So investment income from Markel is mainly the regular income from their portfolio, interest from bonds, dividends from stocks, pretty standard stuff. The Terra Nova deal didn't just bring insurance business. It brought a load of investment assets, too, hence the big jump in income. But the crucial part is Markel's philosophy. It's deeply rooted in value investing principles. They aim for superior investment returns over the long haul.
Not just clipping coupons.
Not at all. They invest in what they see as high-quality businesses, often when they're undervalued, and they hold for the long term. They're owners, not traders. And they explicitly link this investment goal, superior returns, to driving strong growth in book value. The two sides, underwriting and investing, work together to compound wealth.
And it wasn't just that regular income stream. They also booked $109 million in realized investment gains. In a year with that accounting net loss, how important were those realized gains? And how are they different from the unrealized ones we talked about earlier?
Yeah, that $109 million in realized gains was very significant, unlike the unrealized gains, which are just paper profits boosting comprehensive income. Realized gains come from actually selling an investment for more than they paid. And these do flow through the main income statement, directly helping that net income number.
So they helped offset the underwriting losses.
Exactly. In a year where the operations, especially the integration and discontinued lines, were dragging down net income, pulling in over $100 million in realized investment profits provided a really important cushion. The review doesn't spell out exactly what they sold, but it shows they're strategic. They're willing to lock in profits sometimes, maybe to help fund the acquisition costs, strengthen the balance sheet, or just because an investment had run its course. It really shows the power of having that insurance float the premiums they hold before paying claims that they can invest wisely. It's very much that Berkshire Hathaway model.
Yeah, the Buffett playbook. Okay, so big acquisition, integrating market shifts. What did all this do to their balance sheet? Their debt-to-capital ratio went up to 39%. That seems a bit high, maybe, for a company known for being conservative. Did they address that?
They absolutely did address it. And again, their candor is key. Yes, the debt-to-capital ratio temporarily popped up to 39% after buying Terra Nova. A big bite to swallow.
Right.
But the review was very quick to point out their long-term target is 1/3 debt, 2/3 equity, so around 33%. By stating that target, they were clearly signaling, look, this is temporary, driven by the acquisition. Our fundamental stance is still conservative.
Okay, so managing expectations.
Precisely. And for an insurer, balance sheet conservatism isn't just, a nice to have. It's critical. It's the bedrock. It provides the buffer against big unexpected claims, against investment market downturns. It gives them the firepower to take advantage of opportunities when others are weak. So yeah, they took on debt for a strategic reason, but they were reinforcing that their core principle of financial strength hadn't changed.
Which really brings us full circle to Markel's overall philosophy, doesn't it? Growth, discipline, that long-term vision. It all seems to shine through this really event-filled year. They doubled their revenue with Terra Nova Markel International. That shows the commitment to growth via acquisition.
And a key point here is how upfront they were about the process. They openly admitted surprises and integration difficulties. That transparency, it's not just good communication, it reflects their culture. By admitting things are hard, they're reinforcing that learning from those difficulties is part of their long game. They even stated their belief something like, the longer our acquisitions have been part of the Markel family, the better they perform.
Patience is key.
Patience and a hands-on integration process that shows confidence in their ability to eventually make acquisitions work, even if it's bumpy at first.
That's a great insight, and it connects right back to the value of discipline. The struggles of 2000, especially internationally, really put their core values to the test. But the review shows how they just kept coming back to those pillars. Underwriting profitability, balance sheet conservatism, and long-term ownership that create a wonderful business. It's like the tough times force them to reread their own playbook.
It's a classic case, isn't it? When things get tough, you rely on your foundations.
Markel didn't try to hide the initial problems or mistakes. They talked openly about how they were fixing them, what they learned. That builds huge trust internally and with shareholders, and it reinforces that their philosophy isn't just talk, it's how they actually operate, especially under pressure.
Yeah, it shows resilience born from having that strong, consistent culture.
Absolutely.
And for you listening, this really pulls it all together. How those guiding principles got tested by massive change, but ultimately reaffirmed. It's got valuable lessons, I think, about resilience, about sticking to your knitting even when the numbers look rough short term, and how being willing to learn from integration messiness can actually make you stronger down the road. It's like a real-world masterclass in navigating the messy reality of growth.
Well said. So wrapping up our look at Markel's 2000 financial review, we've seen this year of really aggressive strategic growth dominated by the Markel International acquisition. That brought big integration challenges, no doubt, but ones they tackled head-on. We saw that headline, accounting loss, but underneath, a really robust increase in comprehensive income and, critically, shareholder equity, boosted significantly by strong investment results and that helpful turn in the insurance market cycle.
Yeah, it really highlights their long-term vision, their discipline. It shows how a company can build serious value even when the surface-level numbers are contradictory at first glance.
It truly is a remarkable case study in looking beyond the obvious.
Which leads to a final thought, maybe. Given those significant challenges Markel faced in 2000, the integration, that initial net loss, what does it really mean for a company to build shareholder value during such intense transformation? How should we, as informed observers, actually measure success and understand resilience when the short-term numbers only tell part of the story, when the real value creation might be happening sort of beneath the surface, building that long-term foundation?
That's a great question to leave people with. Something to definitely ponder as you look at the companies you follow. Maybe it encourages you, encourages all of us to dig just a little bit deeper than the headlines.